The money in your bank account is not yours. What if I told you the money in your bank account isn't really yours? It's a jarring thought, and one most of us would brush off. We're raised to see banks as unshakable fortresses of financial safety. But what if that trust is the most dangerous assumption you can make with your money? History has a funny way of showing us that even the strongest fortresses can crumble. And the rules of the game have changed in ways very few people truly understand. Picture this. It's the fall of 1929. A man walks into his bank and asks to withdraw his entire life savings in cash. The teller thinks he's lost his mind. His friends call him a fool. But just 48 hours later, the stock market crashes. Banks slam their doors shut. He is one of the few people left standing with his wealth intact. Now, let's fast forward to 2026. If you tried to do the exact same thing, you wouldn't be called a fool. You'd just be locked out. Because today, the system has been legally rewired to stop a mass exit, turning a financial crisis into a hostage situation where your money is the ransom. This isn't some back-alley conspiracy theory. This is about understanding the legal plumbing of a system that's been quietly re-engineered right under our noses. To get how this is even possible, you have to start with a truth that's buried in the fine print of your deposit agreement. The second you deposit money into a bank, its legal status flips. You're no longer the direct owner of that cash. You've essentially become a lender. You are now a creditor to the bank. Think of it like this. You gave the bank a loan, and in return, they handed you an IOU that shows up as a digital balance on your screen. The bank then takes your money and puts it to work to make a profit for itself, mostly by lending it out to others. This is the bedrock of fractional reserve banking. The problem is your spot in the payout line if the bank goes belly up. Now, to be fair, you're not just any creditor. U.S. law gives depositors super priority over most other people the bank owes money to. But it's not that simple. Insured deposits get paid first. Uninsured deposits, anything over the limit, come after. You are lending your money to an institution whose first duty is to its own survival, not your immediate need for cash in a panic. The rules are written for an orderly shutdown, but a real financial panic is never orderly. If this all sounds a little too theoretical, just look at what happened in Cyprus in 2013. It's the modern blueprint for a bail-in. When Cypriot banks were on the verge of collapse, authorities had to act. Instead of a bailout, where outside money saves the bank, they chose a bail-in. Here's what that meant for everyday people. The banks were shut for days to stop a bank run. When they finally reopened, a shocking new reality hit. The country's second-largest bank was shut down for good, while deposits under 100,000 euros were safe. Any amount over that was considered uninsured. At the Bank of Cyprus, a stunning 0.5% of all uninsured deposits were seized and forcibly converted into bank stock to save the failing institution. Let that sink in. Nearly half the money people thought was safe in their accounts just vanished overnight, replaced with nearly worthless shares in a bank that had just collapsed. The government didn't ask. They just did it. But wait, you're probably thinking, what about the FDIC? We see that sticker on the door and sleep better at night. We believe every cent up to $250,000 is guaranteed. And while it's true no insured depositor has ever lost a penny, that promise leans on a fund that is shockingly small compared to the ocean of money it covers. As of late 2020, the FDIC's reserve ratio stood at just 1.4%. That's less than 2 cents for every single dollar it's supposed to protect. The FDIC says this is plenty for isolated failures. But the fund is not built for a systemic crisis, where dozens of banks face a run all at once. The FDIC's greatest asset isn't its bank account. It's our confidence. And that confidence, it can evaporate in hours. So that brings us to 2026. Why that year? Because a perfect storm is gathering. It's centered around something called the commercial real estate, or CRE, maturity wall. During the years of cheap money, developers took out mountains of loans. Now, those loans are coming due, but in a world of much higher rates. In 2026 alone, an estimated $9.6 billion of debt is set to mature. The nightmare scenario? Many buildings are now worth less than their loans. Refinancing is not an option. This is creating a slow-motion train wreck, heading straight for the balance sheets of the regional banks. This is where the hostage situation begins. It won't be a new law that says you can't have your money. It will be a quiet, systemic freeze. As banks get squeezed, they'll do whatever it takes to hold on to cash. Capping ATM withdrawals, slowing down wire transfers, invoking obscure clauses in their terms of service. Think about it. The SEC already has rules allowing mutual funds to block you from selling. Why would banks be any different? When the panic starts, regulators will always choose to save the system over giving you access to your cash. Your withdrawal request won't be denied. It will just be pending. Your money will be trapped behind a wall of digital delays, a hostage to the stability of the institution you trusted. Understanding the trap is step one. Taking action is what separates the survivors from the victims. This isn't about panic. It's about smart, prudent diversification. First, use a multi-bank strategy. The limit is $250,000 per bank. If you have more, spread it out. Second, hold a portion of your wealth in physical cash, completely outside the banking system. When digital systems freeze, cash is king. Third, consider assets that are not someone else's promise to pay. Physical gold and silver have zero counterparty risk. They aren't digital IOUs. They are tangible. Their value doesn't depend on a bank staying solvent. The man in 1929 who pulled his money out wasn't crazy. He was just ahead of the curve. He understood that the ultimate responsibility for protecting his wealth was his and his alone. He chose to take control before control was taken from him. Today, we face a similar choice. But the stakes are far higher. The warnings are flashing. A massive debt wall is coming. The blueprint for bail-ins is public knowledge. In a system designed to make you a lender, the only winning move is to limit how much you lend. The clock is ticking toward 6. You can put all your faith in a fragile system, or you can take action now to build your own financial fortress. For now, the choice is still yours. What will you do?